Hi, this is Deanna Kosaraju, founder of Global Tech Women, and welcome to the final day of the 2017 Voices Conference. I hope that you've really enjoyed it. Today we have a number of sessions remaining that are really about you as a founder, in your professional development and your personal development, and just development as a human being in general. So we hope that you find these last 3 sessions very informational as well as entertaining, and we're glad you're spending your Friday with us. So I would like to introduce this next session. Sorry, someone just called me right when I was talking. This is called Founders Funding Primer, Key Levers from Term Sheet to Exit. So I know many of us in Global Tech Women are either thinking about starting a company or we're in the early stages. This is a great session for you. John Hempill, he's a partner at Sheppard, Mullin, and Lucie Newcomb, who's a dear friend of mine for a long time at Newcomb Global Group Incorporated. She's a marketing goddess. I know she's been doing a lot of marketing for me with Voices, and I'm very appreciative of that. We'll be sharing the session together for the next hour. A couple of housekeeping reminders. We have a chat window at the bottom of the screen. So if you have any questions and would like to ask the speakers a question, please feel free to use the chat session as well. And please, introduce yourself, say where you're from on the chat window, and we welcome you here. So with that, I'm going to turn it over to Lucie.
Deanna, thanks so very much for that warm and kind welcome. It's always a pleasure to be with you at Voices and extend your reach and amplify your amazing vision about empowering women in tech around the world. And with some wonderful allies like John as well. So many thanks for this opportunity. So today we're going to talk about something that comes up a lot in my conversations with founders. I have the pleasure of working with founders often. As head of NewComm Global, I get a chance to work with many female founders from around the world, and almost always in every conversation, the question comes within about the first 3 to 5 minutes. So what do I do about funding? And John is a longtime friend of mine. I won't tell you how long, and has become very distinguished in this area as a partner at Sheppard Mullin. He has also served on the SEC Advisory Committee on Small and Emerging Companies, and has extensive experience in private and public finance, ranging from emerging growth companies, venture capital funds, and more. And so what we're doing today is creating a basic glossary and setting some of the baseline expectations around what some of these things you might heard of are, and what some of the pros and cons are as well. So I noticed that my screen has gone dark, and I'm going to assume that we're still on track here. John, are you there?
I'm here. Can you hear me okay?
There you are. Okay, terrific. I guess the screen goes to whoever is speaking.
Yeah, Lucie, you're fine. I can see you fine.
Terrific. Thank you. Yeah, I can see myself. It's just dark after that. So great. Thanks, Deanna. So without further ado, John, did you want to say anything before we get started on what you and I have called a glossary of basic terms?
Sure. I mean, when I started doing this back in, say, 1992, there was actually kind of I practice in New York City, even though Lucie and I knew each other when we were both in California, where she still is. But when I started practicing in the venture capital space, there was actually a pretty significant difference between the documents that you used on the East Coast as opposed to the West Coast. Nowadays, they're all pretty much homogenized, and everyone's kind of using the same documents. So that's certainly gotten a lot easier. And what it means is that when you talk about doing certain types of deals, when you say I'm doing a seed round or a Series A round or a convertible debt round, everyone knows what you're talking about. Everyone uses the same documents. So it's just become a lot easier. And to a certain extent, I wouldn't call it cookie cutter, but people do kind of know what things are and kind of what to expect.
Great. John, I think that's a great place to start. Just to tag on your point too, which segues so well into the concept that a lot of the terms we're going to be talking about today are originated and largely practiced in the United States, particularly Silicon Valley. So I know we're likely to have some global listeners, and what I can say is that for you, there will be another layer of checking these against your own federal and local regulations, maybe provincial regulations, to see what the practices are there. In most countries outside of the United States, or at least many countries, there is little to no ecosystem for this kind of work. In many of the places where it is developed, the government is heavily involved. So please understand we are offering the best of our knowledge and experience, with the caveat that it's really important that you check this against what's happening locally with you as well. So anything to add to that, John?
No, that's absolutely correct. This past summer, I did a deal involving a Swiss company, and we were trying to do the deal along the lines of a standard U.S. venture capital deal. And so many things we found out that Swiss companies couldn't do that are just part and parcel of the documents that we use in the United States. It was kind of a real learning experience to me, at least, because you would think that Switzerland would be somewhat similar to the United States as far as financing goes, but it's entirely different. So everyone should definitely check their own local rules and regulations. I'm going to be talking about how things are done in the United States, but there are different rules and regulations, especially for entities in various jurisdictions,
Well, thank you for that annotation. And I think there's two comments to make, as we've just said. One needs to localize the information, and the other is to acknowledge that many of the concepts, the venture capital industry, the startup space, all of that, those pieces of the ecosystem were all originated here. So there's even a possibility that if you are overseas and not seeing any of what we're talking about right now, maybe a convertible note isn't in your reality, at some point it might be. So hopefully, and by the way, you might also want to try and do some fundraising in the United States. So hopefully there are some threads of relevance. And with that, I think we'll go ahead into the glossary. John, why don't we take two at a time and talk about liquidity and capital?
Sure. So liquidity is a concept involving how easily you can sell the security that you're buying, be it debt or equity. And in the United States, certainly, the usual startup financing is done through private offerings, and consequently, the securities that you get back in the private offerings are not easily sold, so they're kind of what we call illiquid securities. Capital is just basically the money that you raise and that you use to operate your business.
Great. Do you want to take an extra minute and talk about examples of illiquid assets? Sure.
When the main way that startup companies are funded, the law that it's relied on is called Regulation D, and you'll hear about that a lot. Regulation D was adopted back in 1982 and basically says that high net worth individuals or people that make a lot of money can invest in startup companies that are not registered with the SEC, because these people are presumed to have sufficient knowledge and wherewithal to protect themselves in these offerings. And so they're allowed to buy them. There has been a push, and we'll talk about this later, for other people to be able to buy and participate in this ecosystem. That's where crowdfunding has come in. But historically, up until crowdfunding was adopted last year, it was limited to high net worth individuals, and the securities really couldn't be sold by those people until the company went public or the company was bought by another company. So that was deemed to be your liquidity event when you did the IPO or when you did the M&A transaction.
Terrific. Okay, well, why don't we talk a little bit about securities? Let's take a step back, and can you just quickly define securities, stocks? How else? Some people have shares. What else would you define for securities?
Sure. It's a fairly technical term, actually, though broadly interpreted by the SEC. They will, for example, if you buy a home, you usually use money that you borrow from a bank, and that mortgage loan itself would not be deemed to be a security by the SEC, because it's a commercial transaction secured by your home. However, there's a pretty big secondary market in those mortgage loans, and they get repackaged and things like that. And at some point in time, that mortgage loan actually becomes a security, even though it didn't start off life as a security, because it has to do with the fact that it's being readily traded among third parties. I'm not going to get into the SEC definition of what a security is, but everything that a company, when you're selling stock, the stock is a security. When you're issuing notes as a company to third parties, that's also security. There are some exotic instruments that we're going to be talking about later on that are also deemed, they're all securities, and the SEC says all these things are securities. So you should assume that whatever you're using to raise money, other than selling the stuff your goods, any instrument that you're using to raise money is probably going to be a security.
Okay, terrific. And circling back to two topics we've already touched on a little bit, do you want to talk a little bit more about crowdfunding? When you talked about becoming legal recently, you're talking about something that happened in the US. Maybe let's go back to just the whole notion of a Kickstarter or a FundMe and maybe touch base on that, and then the new development that you're talking about investing opportunities.
Sure, probably I would say 5 or so years ago, suddenly you started to hear a lot about Kickstarter. Kickstarter was deemed to be a crowdfunding platform. But what people did there was that they raised money, but they raised the money by selling the stuff that they made. For example, I represented a company on a pro bono basis that made hangers for plants, right? And so they wanted to raise some money, and they decided to use Kickstarter because they hadn't manufactured the hangers for the plants yet. So they basically used Kickstarter as a way to get the money in so they could manufacture the hangers for the plants. Now, that was all well and good, but when people tried to say, hey, instead of giving you a thing, I'm going to give you a security, the SEC stepped in and said, no, you can't do that, because there are only certain ways that you can sell securities if you're not a public company. And so there was a big push, and as part of the Jobs Act back in 2013, one of the parts of the Jobs Act was crowdfunding, which basically allows anybody, no matter how wealthy you are, to participate in private offerings. There are some fairly significant limitations. I won't go into that. The crowdfunding, the document that the SEC published to describe how to properly do crowdfunding was about 600 pages long. So it's very, very long, very, very complex. Unfortunately, because it's so complex, not many people use it, or at least not many people have used it since it was adopted, or since it became legal to do it back in May. There's certainly have been a number of attempts in Congress, and they're probably going to start at sometime later this year when they get down to like really doing the business of Congress, to try and revise or revamp crowdfunding to make it more usable, more friendly for companies. So we'll see what happens there.
Fascinating. Sounds really, I know that a lot of entrepreneurs are always interested in that, and I think there's a little bit of eyes in the candy store sometimes around that, so I'm glad you created some limitations with that. So I don't know that we've touched on this enough, but shall we just kind of frame the concept of equity versus debt?
Sure. So equity is basically a piece of your company. It's like, look at your company as a pie, and you're cutting up the pieces of pie. That's the equity, okay? And equity can take the form, usually, I'm going to use for purposes of this illustration, I'm going to use a corporation, though a lot of people use limited liability companies or LLCs. But even there, they kind of use the same terms. Usually what you see with a corporation is the equity that they issue is either common stock or preferred stock. Common stock is the basic ownership interest in the company. Usually each share of stock has one vote whenever stockholders are asked to vote on things. Though, for example, Snap, which just went public with non-voting stock. So there the people just have an economic interest, they don't get to vote on anything. Preferred stock is really a much more complex and detailed instrument, and this is what usually venture capitalists, when they come in, they want preferred stock. And preferred stock is called preferred stock because it has a preference to the common stock on distributions out from the company during operations when they issue dividends, and also on liquidation when they sell the company and how the proceeds come into the company and are distributed out to the shareholders. Preferred stock usually gets first dibs. So that's equity. Debt is debt. It's like your credit card. It's like your bank loans. We were going to talk about convertible notes. That's a third form where you go out to kind of the same people you would sell equity to. Instead of giving them equity, you give them debt. Debt has a maturity, so it means that you're getting this money in, but you got to pay it back at some point in time. And usually it also has some sort of interest rate. Sometimes you have to pay that currently. Sometimes you pay it at maturity. And debt can just be straight debt, which means that you have to just pay it back when it becomes due. Or it can be convertible, which means you can convert the debt into equity at a certain rate. So that's the difference between those two.
That's terrific. I'll let you get a sip.
Thank
I
you.
suddenly got the flashing light that my charge that I thought worked didn't work, so I'm plugging in while you're sipping.
Okay.
There we go. And we'll move along. I think the next quick thing before we move into some deeper areas, let's just take a quick talk on valuation and series and seed funds, if you want to take those one at a time or all together.
Sure. So when you're talking to someone that you're getting money from, one of the questions, let's assume you're buying, that they're going to be buying equity, is they're saying, okay, so I'm going to give you a piece of my company here. How much are you going to pay for that piece? So let's say that you're selling them a piece of the company that, let's say you have 80 shares outstanding, they're going to buy 20 shares, right? So at the end of the deal, there are going to be 100 shares outstanding. So they have 20% of the company, right? And they're going to give you $1 million, okay? So what is that? What's the valuation of the company? It's pretty simple math. For 20% of the company, you're getting $1 million. So multiply $1 million times 5, your valuation of the company for that round is $5 million. That's the post-money valuation. Pre-money valuation would be presumably $4 million because that was the other 80%. Now you're getting in $1 million, so that now it's $5 million. Usually the first money that you take in, usually the first money you take in is from your parents, or if you have credit cards, you use your credit cards. Or if you're a serial entrepreneur and you just had a successful exit from one business and you have a bunch of money in the bank, you just use your own money. But presumably, if you're going out to third parties that you don't know, there are really two types of initial financings. And the ones that most people usually start off with are what are known as seed financings, which are small transactions, usually like $1 million, $2 million tops. And hopefully you do with only a few investors, but sometimes you have multiple investors. And so that would be and the seed financing again is usually in preferred stock, but it's a very, very company or founder friendly stock, preferred stock. When you get into the next rounds and you go into what are known as series, that's the series of preferred stock. The seed is usually a series of preferred stock as well, but the series usually talks about your first real big venture capital financing. Let's say $5 million, $10 million, or if you're Airbnb, they just did $1 billion. So
F, no less.
Yeah. But
that's what you call optimists.
yeah. We'll see what happens there. They're now valued at the $30 billion. So goodness gracious, a lot of money. So the series refers to the fact that the preferred stock, you issue preferred stock in series. You have Series A, Series B, Series C, Series D, et cetera, et cetera. If you're private for a long time, you're going to have a bunch of different series, and they're all going to be interacting with each other, so it can get very, very complex. And we'll be talking about some of those complexities later on.
Great. Well, I think this is probably a good place to move into term sheets. And we're going to spend quite a bit of time here. I'll just let John get a snag of water there and say that term sheets are really like a contract. And John's going to go over the varying kinds and what are some of the pros and cons, things to watch for, possible pitfalls, again, targeted largely to the US market, but likely relevant to everyone because these are the basic issues of doing business as a startup. John.
Right. So a term sheet, first of all, is typically, even though it's a contract, it's largely non-binding because it's intended to be an outline of the transaction that you're going to be entering into. And you don't, despite what Sean Spicer said about the new Medical Care Act, small is not necessarily better because you can't kind of fit in all the details to avoid litigation into 3 pages, which is 3 to 5 pages, which is how long a term sheet is. So that's why it's non-binding, because it's just intended as an outline.
So John, if someone sends you a 10-page term sheet, is that a good thing or a bad thing?
Well, I'll tell you, I usually try and get people to give as much detail as they can in the term sheet. So for me, a longer term sheet is better because people have actually addressed the issues and thought them out. And it's better to do that certainly from a cost standpoint, because I don't really get involved with term sheets because, again, they're other than a couple of provisions, they're not binding. So if someone gives me a 2-page term sheet and there's not a whole lot of stuff in there, that means I'm going to be kind of like, first of all, I have to talk to them and figure out what they want. Then I'm going to have to negotiate all that stuff with the lawyer on the other side. It's going to get real expensive very, very quickly. Okay, so the longer the term sheet, the better. But again, you don't want to spend too much time on the term sheet because suddenly the term sheet starts to take over the transaction, and which can be really, really bad because then you don't get to the documents, then you don't get the money, and that's not a good thing. So it's a balancing act.
So pay attention and get the details, but don't get too hung up on it. Correct.
So what things are typically addressed in the term sheet? Well, first of all, the type of security that you're buying. Are you buying equity? Are you buying debt? If you're buying debt, is it straight debt or is it convertible debt? Usually at this stage, the early stage, it would be convertible. Are you buying equity? So it's like, are you buying common stock or are you buying preferred stock? For purposes of this illustration, I'm going to assume that we're doing a preferred stock equity deal. So here are the areas that are typically addressed. Number one is that if the investor is putting in a lot of money or buying a big piece of the company, they're going to want someone on the board of directors of the company. Okay, the board of directors is the managerial entity which kind of does the big decision making for the company. Then you have the officers who do the day-to-day stuff, but the board are the ones that kind of decide whether to sell the company, whether to do a public offering, whatever. And so they're going to want a seat at the table for that, maybe 2 seats at the table, depending on how much money they're putting in. So you deal with the board of directors in the term sheet and whether or not they have a board right. You also deal with what other rights they have. And with preferred stock, there is, as I said, it's a preferred instrument. So what sort of preferred dividends do we get, if any? What sort of return do we get at the end of the day when the company gets sold? And if our preferred stock is a convertible preferred stock, meaning that it can convert into common stock, what are the conversion rights? How much of common stock does it convert into? So those are the things that you look at with respect to the preferred stock. Then you take a look at kind of the outside rights as well. We mentioned IPOs as a great exit event, but once a company becomes public, a large stockholder may want the right to force the company to register their shares and sell them in a public offering. So you deal with registration rights. You deal with certain protective provisions. In other words, your big preferred stockholder may be concerned that I want to have the right to say whether or not the company gets sold, for example. And it may be just certain big details. It may be down to, I want to decide whether who the CEO is. I want the right to hire, the right to hire and fire the CEO. So it can be, you can have a whole lot of blocking or approval rights, or not. Then you also deal with some other liquidity rights before the company becomes public. These are called rights of first refusal, tag-along rights, things along those lines. And those, I'll discuss those rights a little later on. But basically what that is basically how do we deal with sales while the company is still a private company. So those are the things that you deal with. Now, the things that are typically, those things are all typically non-binding, and they're expressly made to be non-binding. The things that are going to be binding are, number one, usually there's some sort of exclusivity period because the investor wants to be the only one to be considered for the investment because they're spending a lot of money on looking at your company and finding out what's going on. So they're going to want an exclusivity period to make the investment. And the other one usually is confidentiality. They want to make sure that you don't use this term sheet, then run off to find another investor and say, hey, I got this valuation here. So those are two terms that are usually binding in a term sheet. But otherwise, it's pretty much usually just an outline of what people are going to do. And then you go on and once you figure out that stuff, then you put in, then you go and negotiate the real documents.
John, is it okay to ask a question here?
Sure.
I know you're you touched on a word that we didn't quite get a chance to discuss in our glossary period, called valuation, which is a big buzzword here and quite a hot button in some cases. Want to take 10 seconds out from your term sheet talk to just mention what valuation is and specifically
Valuation.
what its units are. Mm-hmm.
Sure. Again, valuation is just kind of how much is your company worth, right? Because when you're a private company, if you're a public company, how much is my company worth? Well, I have a share of stock and it's trading for $10 on the New York Stock Exchange. Easy to figure out. But if you're a private company, your stock's not trading anywhere. So how do you figure out what the valuation is? I'll tell you what the valuation of your company is. It's whatever someone else is willing to pay for it. There's no right or wrong answer. You try and get the highest valuation, the investor tries to get the lowest valuation for your company. And how is that done? It's just it's a process of negotiation. There's no wrong or right answer. It's like how come houses are the same house that costs you $2 billion in Palo Alto sells for $100,000 in Kansas someplace, and the answer is location, location, location. But there's no right or wrong answer.
That's interesting because, Shark Tank makes a big deal out of it. The television show Shark Tank makes a big deal out of tying it to sales. Mm-hmm. And so for, seed companies that haven't sold anything yet, I would imagine it's particularly tricky since we have a number of people who might be listening that haven't quite started, maybe even at the business plan stage, and they're asked to talk about valuation before a VC. Do you have a quick tip? I know I'm taking you out of your term sheets. Do you have a quick tip about especially now the ELS areas very early on?
Well, that's why a lot of companies, the first offering that they do is not of equity, but of convertible debt, because okay. The convertible debt instrument basically postpones the valuation process, and that way they can get up, they can get running, they can start manufacturing stuff or creating software or whatever they're doing, start getting some sales in, so they can justify a better valuation. Because convertible debt basically just says we're going to convert into the next round at some sort of discount, and there's usually a cap that's put on. In other words, that it's if the it's either if the valuation can't be too high, and then that way you don't have to worry about what the valuation of the company is because that'll be established in the round that the convertible stock converts into.
Perfect. Okay, well, if we get back to your term sheets, and apologies for the deviation, I just thought valuation will continue to come up and we better touch base there.
No, that's fine. So I mean, there are other things that you can put in the term sheet. You can, certainly talk. There are, like I said, the documents that you use for an equity offering have become pretty standardized. They're actually on a website right now. There's an organization called the National Venture Capital Association, NVCA.org. And if you go onto that website, there's a little tab that says Model Documents, and you just click on there, and they have the standard documents that pretty much, I would say, certainly more than half the time are used in series financings. There's and just to quickly go through them, there's a certificate of incorporation that establishes the preferred stock. There's a purchase agreement. There's an investor rights agreement, which has for example, the registration rights that I talked about, but gives you certain other rights as well, like for financial statements, to visit the company, stuff like that. There's the voting agreement, which is how people preserve their right to elect a director, is by getting everyone to agree ahead of time to vote all their shares for their directors. Then there's the co-sale and right of first refusal, which is what I was talking about a little earlier as well, which deal with the transferability of the stock prior to the company being becoming public. And those are kind of just, they're the standard documents, everyone uses them. And so you can put as much of the detail about what's going to be in those documents as you want. For example, you can go through and talk about what sort of representations you want the company to make in connection with the purchase agreement. What do you want to know about the company? What do you want them to tell you, right? Well, there's a whole slew of things in the NVCA form. There are over 30 separate sections of representations and warranties that go from things that are as basic as that the company has been duly formed, i.e. that I made sure that I filed a certificate of incorporation with the state of Delaware to form my company, down to some more esoteric stuff like, the Federal Corrupt Practices Act, which, you would think that, people wouldn't necessarily worry about with a startup company, but sometimes you do worry about it, especially if they have foreign operations. So, and that deals with
about some of the documents there. Excuse me, I'm sorry, my transmission's been a little funky, so excuse me if I'm stepping on your toes or your voice, as the case may be. So when you were talking about some of the documents there, the rights agreements and so forth, are these like templates almost that can be adapted? Is that what you mean?
Yeah, absolutely. They're, like I said, they're on the website and they're in Word. So you just click on it and then you just copy it onto your onto your own computer and you go.
Fabulous. They could be a threat to your business, John.
Yep. It's a smart document. Smart. Okay. Lawyers are becoming irrelevant. Like I said, when I started in this profession, it was not unheard of to, have lawyers run up huge bills in connection with venture financing. It's not anymore.
Right.
The documents are all pretty much the same.
Well, the good part for you, I hope, is that now people come to you for your expertise and wisdom, and not can you hit the key on the typewriter to hit out the Word doc.
Yeah. Plus, I'm older.
I was using wisdom, euphemistically, but that sounds really great. So as we finish up the term sheet discussions, is there anything else you want to add?
No, I mean, I think that's pretty much it. I mean, those are the things that you deal with in the term sheet. You can, like I said, you can put a lot of stuff in the term sheet, and you can like you can detail what the registration rights are if you want to, but sometimes people just put in, oh, we're going to have like standard registration rights from the NVCA forms. Even though the NVCA forms don't really dictate what sort of registration rights you have, it's still kind of understood.
It sounds really great. I know that both of my friends and colleagues on both sides of the equation can tear their hair out over term sheets, and I see them kind of do it more or less metaphorically very often. So great tips.
Yeah, and like I said, usually the lawyers are not heavily involved in the term sheets. It's not, I sometimes get involved just because I have a lot of business experience. People want to know what I've seen and whether or not this is out of market or not. But that's usually the only time I'm called in. I'm not usually involved in the drafting of it. When the term sheet's done, that's when I come in and when my colleagues come in.
Terrific. And for our social entrepreneurs on the line, I'll just mention there is something called the social benefit version of a term sheet. It's John and I have talked about it, and in order to give you enough Q&A time, we won't delve into it today, but it's pretty interesting. It looks a lot like a regular term sheet. You can actually Google it at social benefit term sheet. And the main difference is that it actually builds value statements into the term sheet. We're going to conduct ourselves in a particular manner. We're going to invest in these areas and maybe not in these areas. So there's a values layer on top of the other terms. It's not really, in my opinion, not being John's experience and expertise, but as an entrepreneur and strategist, it looks very similar with this extra layer of values on top.
Right, and there are certain particular types of corporations that you would form if you wanted to have that type of layer in there. Because the basic rule with corporations is that the shareholders are owed complete fiduciary duty by the board of directors, and they're interested in the things that the board of directors looks for in connection with making any sort of decision. With a social benefits corporation, they can say, well, these are our highest goals, right? So these come even before the needs of our shareholders. So we can go and we can make, products that don't involve animal testing, even though it would be cheaper and better for our stockholders, better for the bottom line to use animals in connection with testing our products. So those are, and this allows you to do that without violating your fiduciary duties to the shareholders.
Yeah, I think it's a real both and solution, and it might even work, we have B corporations now, social benefit corporations here in America, which is actually a whole other business entity designation. It might even be something that people without that would want to use just to create a sense of ethical behavior, because in the age of consumerism, values really matter to a lot of your customers.
Yeah, I mean, again, the thing you have to worry about with those corporations is that it will limit the investors. Your investors will have to agree with your values.
Right, and that does narrow the field, doesn't it?
It certainly, it by definition, it narrows the field. How much just depends on how stringent your values are.
Right. Well, if anyone's interested in this, it's at worldpositive.com, and it's called the World Positive Term Sheet. That's the one that I've seen. So I think we'll move on to convertible notes, unless you want to have any other comments here on term sheets.
No, that's fine.
Great. Well, the other area that's been very technical and that I wanted to bring John's expertise, bring to bear to our table today, one was the term sheets, and the other is what's called convertible notes and safes. Want to give us a little heads up there?
Sure. So convertible notes kind of, I think the first time I saw convertible notes were probably about, 15 years ago or so. And the first time I looked at it, I said, why would you ever agree to this? Because it basically says you're agreeing to convert into the next round, and you have no idea what the next round is going to look like. I had a client that said he was buying a convertible note for this company, and I said, why don't you just give me the money? I put it to better use. And he says, John, this company has a machine that allows you to be weightless for a certain period of time, and if you're a stockholder, you get to use it. So that's why I want to buy into this company.
Well, do you want to take a step back and just explain what a convertible note is, like very pedantically? Thank you.
Sure. So a note is a debt instrument. So equity and debt, this is something that you have to pay back. Okay. It's called a convertible note because it converts into the next round of equity financing. So let's say that your next round of financing is a Series A financing. Each share of Series A stock is valued at $1, right? So that means that this holder of this note, let's say this holder of this note has $100,000. It could convert 1-to-1, so it would convert directly into 100,000 shares of Series A stock. But the way that the market has worked with these convertible notes, and again, I say a lot of people use the convertible notes for the first time to avoid this whole valuation decision. But the convertible note itself, because the people are putting in the money ahead of time, has a discount feature. So usually, let's say it's 15 to 20%. In other words, so that you would actually only have to, you would probably get, for your $100,000 notes, you would get, let's say, $115,000 worth of securities because of this discount feature. But otherwise, it's a note, and so it has a maturity date. It has interest. It has all those things, and that one of the things that people realized after a while in using these convertible notes is that they would have to pay them back. And so the SAFE was developed as an alternative to a convertible note because what the SAFE does, subscription agreement for future equity, basically says, I'm giving you money now, and I'm going to convert into that next round, and it's at a discount, and it has all those types of features, but it's not a note because it doesn't have a maturity date. Now you say, okay, so what happens if we never do another round? The SAFE usually provides for some sort of conversion into common stock at some sort of valuation, so that decision is made in there. But it's a lot of people like it a lot better than, certainly companies like it a lot better because it's not a note. They don't have to repay it. It's just going to convert into equity at some point in time in the future. So so from the company standpoint, they prefer that type of instrument. From the investor standpoint, they still prefer the convertible note. So the SAFE has been out there for, I don't know, probably for 4 or 5 years now. And I haven't used it that much in my practice. Convertible notes are still very, very prevalent, and people use them a lot, but the safe not as much.
Excuse me for interrupting you. When would people choose one over the other?
Well, the company would probably say, hey, I want to use a safe. And the investor would say, but I want to make sure I get my money paid back, and I don't have any confidence that you're necessarily going to do a round in the future. So I want to just make sure I can get my money back at some point in time. So that's the tension between those two instruments.
Got it. Got it. Are there particular industries, particular verticals where safes are more likely to show up in the more speculative areas, like, nanoparticles or something?
I can tell you where I've used them a lot is with internal financings with existing investors. So, for example, you'll say you have a group of founders that have had a successful exit from another company. And so, let's say the four of them own their company. And they don't want to go out and, figure out, or get other investors involved. So they would use a safe internally so that in the event they went outside to get additional investors, then that would convert at that point in time. But until then, it wouldn't convert. It would just be money into the company. That's where I've used it a few times. But as far as industry specific, no, it's not tied to industries or anything along those lines. It's agnostic.
Well, terrific. Well, I just have one more thing to touch base on before we open things up for questions, which we need to do soon. This is a double-barreled question. How many investors should one have, and what kind of attributes should you look for?
The short answer is you should have as few investors as possible, because, and you should also try and sell as little of your company as possible, because if it becomes successful, then you have a bigger piece of the pie. That's pretty obvious. But the one reason why you really want as few investors as possible is because that way you don't have to deal with a bunch of different people, right? And the fewer investors you have, the more the easier it is for you to operate your company, because you're not always responding to all these different types of investors. But the attributes you're looking for from your investors are their connections. Do they have good connections to other wealthy people, for example, so you can raise money from them? Also their commitment to your company. I would say that it's better to have an investor that's really, really interested in your company, that really, really wants to be involved, because in addition to taking their money, you may want to have them on an advisory board or something along those lines, if they're not already on your board of directors. So those are the things that I would look for in investors, and as far as their attributes go, and number, again, few as possible.
Yeah, and hopefully they get along, right?
Mm-hmm. I mean, the worst thing in the world is when you do a round, and it's great if you have one investor, but if you're doing a round and you have like 10 investors, well, this one wants this one wants that, and and you end up with the lowest common denominator, which means that the company gets screwed. So that's what happens.
They're exhausted, and by the end of it, chances are your decision-making capacity has been impaired by all the mishigas, and it gets challenging. Okay, well, that sounds powerful. And last question is there anything that you think, since our audience is likely to be largely female founders, and as we're very aware, in the US particularly, because that's where the ecosystem is, women have had a hard time banging down the door, ending up with around 7% of funding offered. Things are moving slowly, but it seems, I spend a lot of time telling emerging market leaders and entrepreneurs, get in on the ground floor now to build the ecosystem, because it's really hard for us women here to get back in, but you can co-build. What are some of the tips you might use that are trying to establish their companies now overseas, or anywhere, actually, anywhere?
I'm sorry, Lucie, your question kind of broke up. Could you repeat that, please?
Yeah, what tips might you have for female founders?
Well, I mean, I think that the the main thing is that you have to use all of your connections that you have. And it's like I'm in a law firm, so it's like one of the constant concerns is that you have for the junior lawyers, that you have appropriate mentors to bring them along, and even though people I pride myself on being I'm being a good mentor to people. I think to a certain extent, when you're a young attorney, you would like a senior person that is like you, meaning that if you're a woman, you would like to be mentored by a woman partner as opposed to an old white guy like me. So, I think that that's what you try to do is, and the reason why you do that is because they can give you an introduction into that whole area where, you have other like people that are interested in doing that. So it's trying to use all the connections that you have. It's going to be harder. It is going to be harder because, the connections certainly in Silicon Valley are largely male connections. So you have to try and, use everything that you can. Have confidence in yourself and your product. That's kind of across, both sexes. You should always be confident in what you're doing. But I think it's especially important for a woman because, again, you have a lot of men, have that preconceived notion that women are not as, strong or smart or aggressive as men, so you have to overcome that. And, I think it's always good to impress people with your knowledge on the subject. Make sure that you really have your pitch down tight. So those are some suggestions.
Perfect. Well, Deanna, we're ready for questions if there are any. Otherwise, we can carry on.
Okay, there currently isn't any questions in the chat box. I just pinged everyone a few minutes ago to ask them to start thinking about their questions because we do need to stop on time as we have another session immediately following you. But I have a question, John, while we're waiting for other people to jump in. So I've seen where some attorneys will work with a startup and delay expenses in regards to the setup of a startup for some kind of milestone period. Either they get their first round of angel investment, etc.
Right.
Is that common practice in the United States?
Yeah, it's pretty common among the firms that do this. We all know what everyone else is doing. I mean, law firms are the biggest antitrust violation in the world. I mean, it's like we all pay everyone the same. We all know what everyone else is doing, and we all kind of like do the same thing. I shouldn't say an antitrust violation. I should say we're all lemmings. And so sometimes someone gets a bright idea and they decide that we're going to do this, that, and the other thing. But like I said, when you have a startup company, most firms there's usually a startup package because they can just plug the stuff into the computer. It's like you're starting up a company, it's all the same stuff, right? You file a certificate of incorporation, you get a board of directors, you get officers, you raise money, and that's all kind of, you can pretty much just plug all that. You get some answers, you have your client fill out a questionnaire, you feed the answers to the questionnaire into the computer, and out pops a whole stack of documents. So it's pretty commoditized at this point in time. So you can, and most firms that are in this business do have like some sort of flat fee arrangement for you to do that. The one thing is that law firms will also delay fees usually, but they will require a retainer for a certain amount. And the reason for that is because when you're filing documents, it's like, for example, when you file a certificate of incorporation with the state of Delaware, usually you use some sort of service because it's cheaper that way, quite honestly. But the state of Delaware has filing fees and things along those lines. So the attorneys will certainly require you to at least upfront pay all of those fees. So there's usually some sort of retainer involved, at least to pay for the startup costs. But yes, there's usually a deferral until you do your first round of financing. But we will keep a fairly close eye on what we do for you if we're not getting paid currently.
Well, yeah, and the founder definitely should keep an eye on that as well.
You'd think.
I've seen experiences where I'd have a lawyer work on it, and then 20 hours later I get a bill. And I'm like, what? So you got to keep an eye on that.
Yeah, I mean, one of the problems
Any
with
questions. Oh, sorry. Go ahead, John.
Yeah, one of the problems with fee deferrals, of course, is that whenever you're doing anything for free, people look at it as free. You know, it's like an all-you-can-eat buffet. You really should only have one plate, but people take 3 plates. So
yeah. Well, it's important to have the right lawyer to help us prioritize and put those estimates about how much each of these things eventually will be.
Yeah.
Is there any more questions from the group? Okay, no one's taking. Sorry.
I was just going to say we have one other to touch on if you think we have time.
Sure. We'll have to be very brief because I have to jump over to another session.
Okay, thanks, Deanna, and thanks for the opportunity today. John, do you want to take just a very brief moment to talk about assigning equity to co-founders? Is there a particular formula or place to go? Maybe because of the brevity, maybe a reference to offer. Does the VC Association have something about that?
Yeah, there's a lot of stuff online about it. It's like, and I assume what you're talking about is not among the founders necessarily, but when you go outside of the founder base to like hire your first CFO, for example, chief financial officer, how much should that person get for equity? And there's a whole bunch of literature on that. It's like how much stock they should get, what the vesting is. Vesting meaning that they don't get it right away; they get over a period of time, things like that. And there's a lot of literature on that. But again, it's a process of negotiation. And so there are certainly parameters, but people go outside the parameters as well.
Sure, and the co-founder stuff actually does come up quite a bit in conversations that I have. So do you have a particular resource? Is it your attorney or is it the VC Association? Where could people go for more info? Yeah,
with founders, it's more difficult because there it's really just a kind of a process of negotiation. And, it's like I've done work with founder groups all the time. And it's just, who is playing the most important role? There may be a person there who is going to be the real leader and devote all their time to it. And there may be someone who's just there occasionally. And so they're going to get, but they perform an important function. Let's say that they're the software king, right? Or queen, as the case may be.
Yeah, it's very hard.
Yeah. So it's I usually don't get involved in those. That you get involved in those discussions. I don't get involved in those discussions.
Good plan. Well, John, thanks so much for being available to chat with me today and shed some light on some technical aspects so that all of us founders can be successful and the women's focus of Global Tech Women can particularly excel. Deanna, thanks so very much for having us. And audience, thank you for being with us. We've loved sharing and look forward to hearing from you.
Thank you so much, Lucie and John. Really appreciate this. Great session. The recording will be up on the website in about 15 to 20 minutes, depending on how quickly YouTube works. Depends on the moment. So we should have it up there shortly. And also, if you ever want to get in contact with John or Lucie, you can always contact us via Global Tech Woman and we'll reach out and get them connected. I just put a link in here to the next Zoom, which is going to be about compassion will change your life and your world. A great story by Virginia Hunter Sampson, who is also an attorney. So I'm hoping that some of you will grab that link while we're here and head over to the next session. Thanks, everybody.
All right. Take care.
Thank you.
Thank you so much for speaking. Really appreciate it.
All right.
Bye-bye.